My name is Graham Peck, and I'm one of the co-hosts here at Funders and Founders. At Funders and Founders, which is a community of entrepreneurial startups and people who invest in them. We run every other Thursday happy hours, and we've done that since April, when kind of normal happy hour kind of events in bars obviously stopped because of the pandemic. So we've done about 24 of those, and those are every other Thursday. Our next one is a week from tomorrow. And then every other Wednesday, we do these lunch and learns from noon to 1 Central, 1 to 2 Eastern. We were just saying that our next two topics, which are also pretty exciting, are in 2 weeks from today. We're going to have a couple of folks presenting how to build a cost-conscious startup along the way as you scale. And then 4 weeks from today, we're going to have a great presentation about video-based marketing and how small businesses can use that. We are going to be finally releasing our kind of backlog, which is about 10 of these lunch and learn sessions that we've recorded. So today's meeting is being recorded, but we're going to be releasing those soon. Hey, Jeff Paikin, if you're on, which it looks like you are, if you want to give a kind of little preview of coming attractions for what you and Seth will cover in 2 weeks for 30 seconds or a minute, that would be great if you're able to unmute.
Sure, absolutely. And thank you, Graham. Very excited to see the group here. And I actually like smaller kind of tight-knit groups to be able to have a conversation and share questions and answers. So for our presentation in a couple of weeks, we're going to focus in on performance-based cost cutting and how to focus in on the tools that our performance cost cutting team uses in order to reduce indirect spend categories for clients. And we're going to be sharing kind of the inside secrets that we use and techniques that we use in order to accomplish that, so that you could do it on your own with your own resources, time, and skills. But obviously, if there is a need that goes beyond that and you want to engage our teams, then we're happy to then have a conversation. So we'll be talking through kind of the 10 plus different levers that you can pull on the indirect spend category that we look at. Everything from merchant processing to payroll processing to shipping to freight to cloud services to bank accounts to tax refunds and so forth. So that's definitely exciting, and we're happy to be speaking about that. And that's going to be Seth Rubin, who is the co-founder of Profit Trust, and then myself, Jeff Paikin from Outcome Partners. It's a pleasure, guys, and thank you, Graham.
Awesome. Thanks for that, Jeff. So yeah, that's kind of brief preview or commercial for our lunch and learn 2 weeks from today. And again, then after that, 4 weeks from today, 4 weeks from right now, we're going to do one on video-based marketing as well. So yeah, with that, I'll dive into just a quick 30-second intro of myself as one of the co-hosts here, and then I'll be pretty quiet after that unless there are questions. Feel free to type questions in chat, or especially with the relatively small group, feel free to unmute yourself and just ask the question. I know Phil and Erik, our presenters today, will be totally fine with that. So my name is Graham Peck, and I'm a venture partner at St. Louis-based VC Cultivation Capital. I'm a member of our team here in Chicago. We invest in seed and Series A stage B2B SaaS companies, and always take pitches, of course, from folks that are, a stage before that. So glad to help people get their pitch decks in order or find the right angels or VCs for people to pitch. And in addition to that, I also work with a strategic partner in Ukraine called Bright Grove that helps build effective remote software development teams. So if anybody has any questions about building and recruiting highly functional but remote, lower cost developers, then please don't hesitate to reach out. Another one of our co-hosts at Funders and Founders, who's not on our call right now, but will be back with us in a couple minutes, is a good friend of mine named Matt Camp. Matt is the head of partnerships at Deal Machine. You can find more information about them at dealmachine.com. And they help real estate investors generate proprietary off-market deal flow. And so with that, I will certainly hand the mic over to our third co-host, Phil Rader, and certainly super excited about our topic today, which is like everything finance for startups. So Phil, you want to give not only your background, but also kick off into our presentation?
Sure, and I think I've had a little bit of whirlwind of everything finance in my background, from a brief stint in financial advising to coming up to the city as a sixth man in a lower middle market private equity firm, doing that for deal origination for a while, really cutting my teeth there, and then coming to this ecosystem 2 years ago, falling in love with it, and probably never leaving. So with that, I came to early growth. So we are, an outsourced strategic financial partner for pre-seed all the way through potential exits, startups, venture back and venture bound. So providing not only, everything involving valuations, tax, R&D credits, sales tax, anything you imagine as they scale, but also our CFOs and accounting services to really give you that kind of outsourced anchor in that C-suite position and expertise for as much or as little as you need it on a month-to-month basis as you scale. So we have Erik Berk here, who's one of our seasoned CFOs in New York. I personally run business development kind of for the East Coast. And really we'll kind of go over, I guess, a quick little stint of slides as well, introducing Erik, and really try to turn this into a more conversational as we kind of talk through the normal, I guess, foundations of the financial build up for any startup, and kind of little pitfalls we see more frequently as we've seen over the years. So Erik will real quick hit present and kind of dive into this, and then we can give a little overview.
All right. Well, let me start with just who I am, and thank all you guys for joining today. I've been lucky enough to be the CFO, VP of Finance, Chief Bottle Washer, whatever you want to call it, for a number of startups. And now am able to kind of work with founders in a way to hopefully help make sure, yes, there are going to be pitfalls, but let's manage the process along the way. I just want to take you through two of my companies before I joined Early Growth. I joined Early Growth about 1.5 years, 2 years ago. But if we go back two companies, there's a SaaS company called Automotive Mastermind, and we're big data for car dealerships. We would take 7 years of a dealership's database, look at all of the customers, and using AI predict who would buy when and why. I was employee number 35. I walked in with a first CFO of the company, there for our A round through, and we sold to a strategic for nearly 400 million. It was a ton of fun. And lessons learned along the way were really important, some of which we'll talk about later today. After that, I spent time at Security Scorecard, which is a SaaS company focused on corporate cybersecurity, companies like Goldman Sachs, the NFL. And there the challenge was growing revenue. And we were in that stage of really trying the land grab. And, we were very aggressive and were able to double revenue year over year. So those have been two of the fun places that I've been able to use finance as a tool. And that's the other thing we'll talk about today, because done right, finance metrics, KPIs really are tools to help us manage. And that's kind of what this is all about. So Phil, if you want to move on to the presentation.
Yeah, maybe it's more of just a few talking points. I'm happy to have it conversationally like this.
Yeah.
Really just diving into kind of the first, I guess, let's do this more of an interview. So I guess on the style of just whenever a company is kind of coming into building out their finances for the first time. So let's say that you just incorporated, you got a couple expenses, you're building your MVP, just talking about just quick, easy tips on what they should be doing while they're kind of doing it themselves.
One key is going to be, okay, the one key is going to be detail. And what I mean by that is, you don't need an accounting system yet. You will at some point in time. The one thing to do is just make sure you keep track of all your spending, okay? Ideally, just create a separate bank account, okay? Isolate what you're doing and try and track both the real costs that you're spending and also time. Because you really want to be able to build that up and understand that. The key to me is, what is the problem that we're solving? And then how does this build up relate to that? So I hope that makes sense, Phil.
Yeah. And I guess as companies are growing and getting to the point where they have, some of this infrastructure, they're building out a little bit of their accounting functions, when they're looking to try to present, even at pre-revenue, the target markets, everything else, how would you suggest they go about building potential projections as they're trying to go to investors?
Well, I think you have to have, and it's without some form of projections, without some budget, to me, you're in one of those restaurants where they give you, the menu without prices. And those places scare me. And as a founder, look, your most precious resource, one of your most precious resources is cash, right? So you need to be able to forecast. And quite honestly, it early on is pretty simple because it's basically going to be people, right? So, are we spending on people? Where are we spending? How are we doing that? Because we've got to build the product. We've got to build whatever it is. Now, hopefully, one of the things we're going to do is build out and lay out a forecast that A, is real, but B, also has some KPIs and metrics because we're pre-revenue. So the issue is, how do we measure ourselves to make sure we're on track with what we said we're going to do? And I think that's very important as you build that and lay that out. As you get a little further along, they're kind of standard models that get used. For instance, if we're at the point where we want to add salespeople, let's say we're ready to do that. Capacity planning is a kind of is one very simple way to do that, which just is talking about how many leads does a business development rep generate, how many leads, and of those, what should we close? What's the lead time for somebody coming up to stream? Does it take 2 months to get ready, 3 months to get fully up to stream? And just building that out. That allows us to have metrics to compare against. It allows us to begin to have, especially as we're hiring salespeople, quotas that make sense. It's all part of managing the process, and really finance done right and budgeting done right is a tool to help manage the process. It should not be simply a numbers exercise. This really should be a strategic and operational exercise. That's when it's done best, guys. And that really is driven by kind of the founders, the process. And part of what we're trying to do is at the beginning, get ready for scale. So at some point, we do need to jump to an accounting system. At some point, we probably need a CRM. But we need to be in a position where we've budgeted for that, so we're ready to make those investments and make them sound. I hope that makes sense, guys.
Yeah, and I guess as you're looking at that early development, early product, and bringing on even friends and family money, because one of the biggest issues is how should I manage and where should I be going for advisor roles? What should I be doing on how I should be issuing these certain, stock options? How should I structure the vehicles in which I'm using for this fundraise? All in those early stages before even I get to that institutional raise and that priced equity round.
Look, I think early on you want to use equity very carefully, but effectively. So advisor boards are really important. Advisory boards to me are really important. So, if you're going to be able to get folks that can truly help you, that can truly move the needle, you want those folks to be aligned with you from a stock perspective, Phil. So, totally makes sense. The friends and family issue to me is a double-edged sword, just because it is friends and family. On the other hand, I've almost never seen an entity where we didn't have some start, which came from friends and family. So, it's ideally you're setting the right expectations at that point for timing and kind of the risks of the business. Look, I know it first person. My son's, I'm in Manhattan. I've got a 23-year-old who's in another bedroom in our apartment right now, building a company that we're part of the family and friends round of. So I understand it from both sides. So I hope that helps.
Yeah, and I guess structuring that because it is a personal versus a pure business relationship, whether it's friends and family or maybe it's angels before it is institutional, just kind of what vehicles you see using? Should they be running different valuations to do a strike price for issuing those stocks early? Should they wait until that? Just kind of helping out in the timing of all those
Okay,
tactical issues.
I think so much of it depends on what the right success markers are for the company. Depending on what you're trying to build, it may be, maybe it makes sense to do a small family and friends round because you believe in 6 months you're going to have some contracts signed, which will allow you to have a different valuation at that point. And then you really want to talk whether it's to family funds or potentially to kind of, your first seed round. To me, it's too much dependent on the nuances to have kind of one answer. It's part of why, as smart founders, you're finding and working with good mentors and other folks to help with that part of the journey. So again, I hope that makes sense. I'm not trying to sidestep it. It just, I don't think there's an easy answer for it.
Understood. And I guess as you talked about different things on pricing and really getting those first customers in, whether proof of concepts or not, and really being able to hone in what the pricing model looks like. And I know that's different for, with many e-commerce companies in this, group, which I know is an area of focus of yours, or more SaaS. So I guess if you could give any examples on kind of how you hone in on the pricing models for either of those two industries that have been areas of your expertise.
Well, I mean, look, pricing is going to be very dependent on your pure competitive set, right? So you begin to look at kind of that first the first circle of the immediate competitors and try and get a sense of where they are, understanding also what problem are we solving? What's the value that we're giving to whoever our customer is? And then trying to from that, look at what we think is a reasonable rate of return for them and for us. When you look at a less granular level, you look at simple things like the rule of 40, right? And the rule of 40 is nothing more than what percentage is my annual revenue growth plus whatever my net income percentage is. So, you can be growing at 100%, but if you're losing 60%, that's actually fine within the rule of 40 because it says you're investing for the future. On the other hand, if we're growing at 50% and losing 40%, that says we've got kind of a basic P&L that's out of whack. And again, we're going to get hammered on valuation. So I hope that helped there a little bit, Phil.
Yeah, and I guess diving into that too, you mentioned the competitive landscape and how founders should be thinking about structuring their initial valuations at different stages. Pre-revenue is very different in different industries.
Look, I think there's more and more pressure today on, post-COVID or COVID, whatever you want to call it, on the real route to profitability. I've got a stable now of about a dozen companies that I help at early growth, and a number of my companies were able to raise during COVID because we had kind of two basic factors going for us. We had significant revenue growth, and we were also being able to grow it profitably. And I just think, and guys, chime in that people are looking harder and harder at investments in a way today. There's a lot of money out there. There's still a lot of money flowing. Don't misunderstand me. But I think the secret sauce and the kind of market verifying that is more important today than it's ever been. So I think some of this timing may be changing as we're speaking, Phil. I've got guys who I think pre-COVID would have already gone to funding, who now we're waiting on 2 large contracts, and once we have that, it's kind of okay. We're ready to roll. But I don't know if you guys are finding that in the marketplace. I'm curious if anybody else is seeing that.
Graham, Jeff, anyone like to comment kind of on what they're seeing in the marketplace on the kind of particular on the valuations being hammered a little bit?
I mean, I would say definitely that valuations seem to still be up. And I've been thinking a lot about why that is lately. I guess I would say in the episode of my podcast that was just published yesterday, and another one that we're going to record actually tonight, my co-host and I believe that it has a lot to do with the interest rates being so low, so that cash has kind of chased up the risk versus reward stack. And so we think it's a lot about monetary policy driving more influx into private investing spaces, and that has actually been part of what has effectively pushed valuations up. So I guess my question or potentially concern looking at like the public markets is companies' revenue and in some cases profitability are down outside of probably the technology sector, yet the market sets, all-time highs pretty frequently. So I guess I would have, and I think that has all trickled back to private markets as well. So I would say my general comment is that we're seeing valuations being pretty substantially up, and it's seemingly a ton of capital chasing, those number of deals. I don't know if that's really the exact answer to your question, and I strayed a little bit like usual, but that's what I think. Not speaking on behalf of my team, just my personal observations.
Would agree.
Interesting.
Okay.
And are you seeing a different class of company that's coming across your transom?
You know what, for us, not really, because we've always been very value conscious, high traction for the dollars we're deploying investors. That's just where we find ourselves in the market and the way that our team thinks that we're able to help. So I would say if you look at annually recurrent revenue dollars compared to enterprise value at which we invest, if you build that ratio, I would say we have historically always invested at a very low multiple EV of ARR,
Okay.
especially since the inception of our second fund, and we're now preparing to begin fundraising for our fourth. So we're preparing to close out Fund 3 later this year. So, that's been a key tenet of our thesis. It was just that we're value conscious investors, right? You can look at data that also compares enterprise value at exit to total capital raised, and that ratio is return versus capital raised, and the return is higher in the Midwest. So we don't only invest in the Midwest, but one of the tenets of the Midwest, while there are smaller number of total deals, they return a higher multiple upon exit when they do exit of their invested capital by between 0.5x and 1x, depending on which other region of the US you're comparing it to. So from a data perspective, I guess that would be my answer there. What are we actually seeing? Yeah, I mean, valuations have certainly crept up, but I would say the traction that we have invested in has also moved up approximately in parallel as we look at deals. So again, using that kind of enterprise value to ARR, using that ratio of those things has been pretty consistent for us across our second and third funds.
And why do you think the Midwest is outperforming?
Well, again, to be clear, I'm not specifically saying it does outperform because there's less capital raised and less exits. But well, in that data, which I forget what years that data was pulled, I can find that reference. It was actually a chart made by my podcast co-host, Jason Rowley. But in any case, off of some Crunchbase data, because he previously was a data analyst for Crunchbase. In any case, I don't know, but I would think that, a lot of people would probably theorize generally that in the Midwest, there are less likely to be really high flying companies, but there's also a lower cost of living. So burn can be reduced, and people to get investment many of the investors are requiring a higher level of traction. So I think it's just the dynamics of the market locally. Again, I think that's less likely to produce, that reduces the likelihood of producing a unicorn, but it increases the return, as measured by enterprise value divided by total capital raised. And again, lower cost of living than many other regions of the country. I mean, Chicago's a big city and it's relatively expensive, but compared to a New York or an SF, it's obviously very inexpensive.
Yeah.
So if you want the access to a big city, but not the price tag associated with New York or SF, you could look at a Chicago, you could look at an Austin, you could look at a Denver, something like that, depending on what your technical definition of the Midwest is. And you might find that, that again, your salary for the same caliber of talent would be lower as well. So your burn's reduced.
Yeah.
Agreed. And I guess,
so I think it's a combination of those factors: increased traction by investment and reduced spend on mostly people, which is obviously where startups are spending the vast majority of their capital, people and sales and marketing. So,
yeah.
And obviously through COVID, the overall geographical location barriers that had been in place, and there used to be different size rounds categorized different ways based on geographic locations, I think has become a little bit more null and void as investors are more comfortable investing through Zoom in other areas, with the founding team not being in the main coastal regions. I guess pivoting kind of a little bit further down, kind of the life cycle and growth of a company, as you guys are having great banter here. Not only on here, we're talking about valuations for the investment coming in, but Erik, as you're representing and preparing, if you're not even attending, for your companies, what do you usually see kind of the maybe a few different areas that the investor reporting as you're preparing companies for that, where founders are not necessarily prepared or are leaning on you a little bit more for the rigorous investor reporting in these quarterly board meetings?
Sure. Look, a lot of it really comes down to kind of data quality and metrics, and really trying to understand from the company's perspective and the board's perspective, what are the things we really want to track, and then let's make sure we understand the definitions and track them. So whether it's CAC per dollar of new ARR, whether it's magic number, there are a bunch of metrics in the SaaS world that are really important. But that's where it tends to occur, Phil. It really is a data clarity issue. It's just being sure that the data is clean, and then it's us sharing it with the organization, and it when done right, it becomes part of our DNA. So if I go back to Automotive Mastermind, I mean, there were 4 key metrics that we focused on. We started every all hands meeting with them. Nearly every non-sales incentive had some form of them mixed in. It's just critical that becomes part of your corporate DNA, because for hypergrowth companies, culture is critical. And some of that culture needs to be grounded in some real numbers. Not so much that it harms the culture in any way, but it keeps us aligned and lets us, I think, grow in a sane, rational way. I hope that makes sense, dude.
Yeah, makes complete sense. And I guess before moving on to my next question, we had a question from the audience. Kind of question, talking about traction metrics. Have we seen a change in how investors view traction metrics for pre-seed or seed stage deals? I think we touched upon that a little bit. I personally have seen, pre-seed funds that are even labeled as pre-seed seed funds that really aren't. They said that maybe there's been 1 or 2, but they really haven't dove into pre-revenue companies, or just don't have an appetite for it right now. I don't know, kind of, if you've seen anything a little bit more as you're working with your earlier stage companies.
Yeah, I mean, the traction metrics that in some of my companies have been really important, and it's kind of pre-revenue, but it's proof of concept, right? So if you've got POCs, the question is, how are you doing winning those? Because in many cases, that's kind of the step pre-revenue to getting in there. the other traction obviously is, and it depends on where we are, but obviously churn, right? I mean, because it's a question of, are our customers staying with us? Is the problem we're solving working for them? So that's my 2 cents on that one, guys.
Understood. And I guess trying to see any other specific areas that you've seen, I guess, over COVID that have really been.
Okay, no, hold on. Let me answer this question. So, guys, what's kind of cool is if you look at this question, it gets right back to the sales equation. All right, and the sales equation is nothing more than number of leads times conversion times ARR divided by time to close. And it looks like for you guys, time to close is the issue. Are these enterprise sales? Can you give me a little more understanding in terms of?
Yes. So, hi, Anwar here. I run Data Spine. It's a machine learning operations platform. So it's enterprise customers, and we've started switching more towards smaller setups like startups and scale-ups, but
Okay.
our pipeline is primarily enterprise right now. And that's why the time to close a deal is long, purely because of
It's the problem of hunting whales, right?
Yes.
So yeah, no, I mean, it sounds like you're doing which makes sense, is to try and kind of bifurcate the hunting, so that there may be some whales you go after, but I think that SMB type market, if it makes sense for your business, I don't know how turnkey it is to add a customer to what you do.
It's self-serve.
Okay.
So you can sign up on the website as well, take the platform out for a spin, and then getting it onto your infrastructure is also pretty much self-serve. So the actual onboarding is not that difficult. It's just that I think the market that we were chasing was not the right one, or as you said, we're now trying to bifurcate our effort.
And have you seen traction on the lower side start at this point, or?
Yes, we are, but then again, the check sizes are not as large as the enterprise deals.
Right. But I mean, the other challenge with enterprises, they again, long cycle, big dollars, and probably painful support. I don't know.
Not so far.
Okay.
So far, it's been pretty smooth sailing with our.
All right. So can I turn this back onto the conversation where we started?
Please.
What kind of financial planning do you guys have in place? Like, how are you building this out to make sure this makes sense? How are you creating the right tools along the way, or kind of road posts, so you can say, you know what, March is a good month or March is a bad month? Tell me what you're doing, because I'd love to understand
that's something that Phil and I have discussed in the past as well. That's something we haven't paid a lot of attention to. Because we're right now focused a lot more on building the platform itself and sort of getting all the functionality that we've been requested for by clients. But yeah, it's pretty much spitballing right now on the planning front, specifically the financial planning.
Okay, but then I hate to say it, that scares me, dude. Having been up late at night many times because we were running out of cash. When we actually knew kind of where we were with cash and what was happening, what kind of simple tools do you want to put in place to just manage that?
So I think the tooling is not the issue. It's just that it's more of a focus problem right now.
Okay.
I'm the only one that's sort of running the business side of things. The organization is extremely engineering heavy. I do have a finance background, so whatever I can, the amount of sort of discipline that I can put in place, I've done that. But again, it's not very systematic. It's more ad hoc.
Okay.
We do have an understanding of where we stand in terms of our burn, our runway, and any incidentals that we might come across along the way. But it's not as systematic as I want it to be, if that answers your question.
Okay. Yep. No, and it's look, as long as it's meeting your needs right now, that's fine. It's just, we want to be ready for when that hypergrowth starts to happen, that you've got the right infrastructure.
Right. And that's where Phil and I have had multiple conversations, and I think I'm just waiting for that right time to get that in place. Right now, we've just had minimal funding. We're an Accelerprise portfolio company, and we've been running on about 100K since last September.
Okay.
And we still have about 5 months of runway.
Cool. Okay. I mean, it's a long time and not a long time. That's all.
Yes. No, that's why we're planning to start the raise process in April. And that's what my question was regarding that. How do we position the deal where any significant deal that will change metrics so as to position it as a seed stage deal or a pre-seed stage deal won't come in. So that's what I was wondering, that how do we position our next fundraise as.
So I guess my question would be, what kind of financials are you planning to have tied to the fundraise? Because one key for me has always been to have financials that show significant growth, but also financials that I know I'm going to meet or beat. Meaning, and I'll give you an example. At Mastermind, we were growing very quickly in number of new dealerships, which kind of was what everybody was focused on. But I also knew that average order value was growing. And I kind of took a little out of average order value just to make sure I made sure the total revenue was a number we'd beat or exceed every month as we were going through the fundraising. Because it's right then when, if you miss something, it becomes an issue. So what have you built to help support that fundraising?
I'm not sure if I understand that completely, but I can just walk you through what the sales pipeline in terms of, let's say, ACV looks like currently, and what it will look like once we switch focus, or rather on the SMB side. So the ACV is typically in the 150K to 250K range, ARR. And on the SMB side, that's where we don't have a lot of clarity. The smallest sort of revenue stream is around $200 a month. And that's what we are seeing right now. But that could potentially grow, but we don't have visibility on that.
Understood. And I think kind of from a broader spectrum here, everyone and more going into, it's one, I guess, as you're preparing for the fundraise, start preparing for the fundraise and start fundraising before you announce on that end, probably at least 6 months out before you actually want to close.
Right.
Two, I think, as Erik was saying, even as you're having conversations with the investor before you announce your raise and they're asking questions about the business, you want to show that there is this potential growth you're going to hit, but don't overpromise. And I think that's what Erik was saying. They're looking to prove that you're an operator and live up to what you said you were going to do. So almost try to take a haircut on what you'd say you're going to hit, because you want to be able to come back like, oh, because they'll remember, did you hit that number you told me you were going to hit in the last 60 days? Oh, yes, we exceeded it by 10%. That's what you want to be able to say throughout the fundraise process as soft commitments or hard commitments are starting to come in. Because if they see you missing those, that could be the difference between the check being written or not. Is that pretty accurate, Erik?
Yeah, I mean, I actually had an experience where we were down to looking at 3 potential investors, and we missed a number. We missed a number of new customers. 2 of the guys fully understood it. A third potential investor got really squirrely. And the good news for us is it said early, we learned kind of who we wanted to work with long-term and not just based on that. But yeah, it can throw a pipe in the spokes. And look, credibility is and as an investor, I want to be sure you know your business. So if you tell me X, it's got to be X or better. If it's not, then let's understand why. What happened? So I hope that makes sense, Phil.
Yeah.
No, it does. It is valuable advice. Thank you.
And I guess going to that next piece, particularly talking about, I know something you hone in a lot in, and Erik, is it's not just the financial piece. The financial piece has to meet the operations. And we talk about metrics and KPIs and everything else, but what does everyone get excited about? I'm actually a PD guy. I always joke and say I'm a bottom line guy in a top line industry in the VC world. So we're all excited about sales, 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 sales. But let's dig in a little bit more when we're talking about these models and different things. What another key piece is the sales onboarding is one area you always talked about. If you want to dig into that, Erik, about how that has to meet the onboard time of what, you know, the sales is coming in, because that can really break down. And then your least favorite word, churn.
All right, let me start with the onboarding piece. And guys, all it is one approach to laying out sales planning is capacity planning, right? Which says, as a salesperson, Phil's going to need 10 leads, going to generate 10 leads a month, and of those, he's going to close 30%. So he's going to close 3. But Phil needs time to get up to speed in his industry. Even if he's been with a company other than Early Growth, he's coming to Early Growth, we work differently, we have different process. It's a different product he may be selling slightly. So it's a combination of how long does it take a salesperson to get up to speed with how many, kind of what have we sent as the right benchmark. Because, you know, if a salesperson is going to be 35% effective month 1, 70% effective month 2, and 100% effective month 3, that's very different than, and that may be right for an SMB environment. An enterprise environment may take much longer just because it's got a longer cycle to begin with, and it's maybe harder to get to the right folks. But that sales component is critical, as is kind of that total number. Again, this all goes back, guys, to that sales equation I talked about, right? Because if you're able to decrease the length of time to sales, that improves the value on the sales equation. So I hope that makes sense, Phil.
Yeah. And I mean, I think that is of any business, regardless of its product, service, you know, even delivery time.
Mm-hmm.
I'm moving across the country and trying to time out exactly when a delivery window is going to be of when right after I arrive. It's anything there, and really building out that sales processes and making sure it's a simple economic, you know, supply and demand.
Well, it's that. It's also, again, I'll come back to tools. It's a good CRM. It's sharing the right information. Sales are multi-point, multi-touch. You know, it's not a simple A/B switch. It's really understanding the customer touch points. It's hopefully having good supporting documentation, whether they're white papers. It all depends on what kind of business as to what the right touch points are in that customer flow. But it's important for you to be looking at that and really understanding at different parts of the funnel what your close rates are. So, you know, if POC is important to your business, kind of, then, you know, I know in most of my businesses, if we're in the POC phase, we want to close at least 50% of them, because it's a proof of concept. We know we're up with at least against one guy, because we're usually replacing the incumbent, but there may be 2 or 3, but kind of we set the bar at 50. So hope that makes sense.
Yeah. I guess as we now are kind of looking at about 12 minutes left in the hour, I wanted to open it up to the rest of the group a little bit and see if there's any kind of pressing questions, clarifications on any of the areas that we've kind of talked about, and happy to dig in deeper on any of them.
Hey guys, one other thing, and this is just a total administration operational nit, but for any of you that are Delaware Cs, I just want to make sure you filed your franchise tax. It was due Monday the 1st. It's no biggie. Just make sure you do it if you haven't.
I've already looked it up for a few people. It's a $200 penalty, and it grows at 1.5% each month that you don't pay it. So
yeah, just an administrative nit from a nerd here, guys. So, but yeah, any questions you guys have? Any you know, love to see what we should focus on next.
Well,
Anyone? Bueller? Well, hearing that, Phil and Erik, this has definitely been informative and helpful. We appreciate you guys sharing the extensive, kind of body of knowledge that you and the early growth team have developed over so many years. Obviously, everyone can feel free to reach out to Phil or Erik. Phil, maybe if you want to drop yours or both of your contact information in the chat, just as a wrap up, that would be probably super helpful for folks. So again, Phil and Erik, want to thank you both for your time and expertise. And I know as the new rooms feature is actively being rolled out and rolled to a new version at Entra. One thing that I might suggest is that you guys and the early growth team offer some office hours on the Entra rooms where people can come and ask maybe more detailed questions in a format similar to this moving forward. So with that, thanks everybody for attending. And what's that, Erik? I'm sorry.
I said, no, that's awesome. Thank you. No, I think it's those kinds of events are really fun. So.
Yeah. So with that, I want to thank everybody for your time and attendance today. And again, we'll hopefully see you next Thursday, a week from tomorrow, at our happy hour, which you can learn more about, through the Entra platform. If you have any questions about how to sign up for Entra, I'll also put my email in the chat. Feel free to reach out to me. And otherwise, everybody have a great week. That happy hour is from 6 to 8 Eastern. And again, 2 weeks from today, we will do the presentation we talked about building a cost-conscious startup along the way and seeing some tools of how to reduce spend. And 4 weeks from today, we'll have a presentation on how startups can use video-based marketing. So, Tino, yes.
Yeah, one on cost control. Since you were just talking about franchise taxes, a lot of startups start with this enormous common stock pool. If you reduce it to like 1 million, you'll reduce your franchise taxes.
Right. But there are two calculations for franchise tax.
I know that. But it's just the potential for all these non-users.
When you first leave from the state of Delaware, you owe $64,000, and there's nothing else on the screen. Yeah, but again, there are two calculation methodologies, guys. If it's based on total assets, you will usually pay no more than $400 plus the $50 filing fee. But yes, at first glance, you do have a heart attack when you see that.
Yeah, most startups don't have a lot of assets, but mine, the only thing we got on a balance sheet are cash on one side and
right. But again, that total asset value divided by your shares is going to create such a low par value that, again, the valuation will be about $400 in total for Delaware.
And I guess while we're on that, in a closing comment, while we're on that topic, did you want to give a quick overview on just kind of R&D taxes and how founders should be thinking about using those as they scale?
Yeah, look, the R&D tax credit is something every tech company should take advantage of. Assuming, and it's based on U.S. spending, but you can bucket all of your R&D spending together. So it's headcount, consultants, AWS, additional software tools. The federal government gives you a 10% tax credit on that spending. So if there's $100,000 that we've put in pure R&D spending in 2020, we file for the R&D tax credit, we would end up getting a $10,000 credit, which we could use against future federal taxes. So and it's really the payroll tax that it gets used for. So it helps our cash flow going forward. We also get a state credit, which is smaller, usually about 7.5%, that we can use against state taxes. But it's just a standard tool that every young tech company should take advantage of. It's not an onerous process. The way that you do the study, it's basic time and materials. So we sit down and talk about who did what and a rough percentage that we think is appropriate for pure R&D, rather than operations and kind of existing infrastructure. So hope that makes sense.
Yeah. And sorry to keep on thinking about little class things to wrap up with here, but I guess one thing I'm always running into, and I know it's one area we focus on, is say you're going and you are along your first fundraise or your second fundraise, whatever it may be, usually first fundraise, institutional fundraise. How should people be thinking about kind of running a valuation pre-fundraise closing and after fundraise closing for kind of setting that strike price for their stock holding early employees?
Well, I mean, stock price is going to be set by your 409As, right? So effectively, the 409A is going to create the bottom for what you can set as your pricing. Then it really is a question of what do we think is attractive relative to where we're. I can't come up with a stock answer on that one, Phil. That's when there's just a bunch of nuances that come in. It's all based on timing, a whole bunch of different factors.
And that's really where I was kind of asking. If say we're closing our first round, it's coming up, and we're about to have to run another one, but we haven't set the strike price. Kind of that type of scenario. Do we set the strike price because we have to on the 409A to make sure we're locked in for the lower strike price for the employees, and then obviously you have to run one after the fundraise, or just kind of walking through the scenarios? We get a lot of different questions on that. There's a lot of people that run their first one through Carter, but don't get as much answers or hand-on support on that one. So just trying to see kind of what you've seen with your companies, if they're running kind of one right before, one right after, or how they usually run those 409As.
I mean, look, the 409A you have to do once a year. You then have to do a 409A if there's a significant event that's occurred. So after fundraising, you have to do the 409A. What that will mean is that'll create the new strike price effectively for shares at that point going forward, right? That creates the new floor. Old floor is still in effect because that's where it was at that point. So I'm not sure where you're trying to go with it, bud.
No, that's it. I was just trying to kind of walk through that piece as one piece we just kind of hadn't covered, but without that, I look forward to
valuation becomes the bottom. That's all.
Okay. Well, no, it's been great having everyone, seeing a lot of familiar faces here today, and look forward to seeing everyone, I guess, in 8 days on the happy hour. And Erik, really appreciate you taking the time today, and we'll try to look at further kind of office hours to run a little snidbit if you saw of an office hour, I think, with Anwar a little bit on his company, and kind of how Erik really kind of digs into the meat and potatoes and the operations of that. But we'll look how we can get that activated through the Entre Network as well.
Cool. Thank you, guys.
Thank you.
Thanks again, Phil and Erik. Have a good week, everybody, and we'll see you a week from tomorrow on the happy hour.
See you soon. Bye.
Cool.